Good morning, good afternoon, good evening, everyone. It is a real pleasure for us to welcome you to our Emerging Markets webinar, Hiking at Different Speeds. This is our first event fully allocated to emerging markets, reuniting the three CIB research platforms, New York, Hong Kong, and Paris. Benito Berber, our chief economist for LATAM, Trinh Nguyen, senior economist for emerging Asia, and myself, Lisu Paez-Cortez, the senior economist for emerging EMEA. We'll be presenting today the content of our recently released Emerging Market Monitors report. This time focused on the different paths that emerging markets, central banks have been taking on their monetary policy stances. So to make it brief and go into the subject directly, so we're going to have Trinh, who will start presenting this main topic, this main subject, followed by the regional outlooks, starting with Benito and Latin America, then myself for emerging EMEA, and Trinh to close for emerging Asia. So I hope you will enjoy this presentation, and Trinh, the floor is yours.
Thank you very much. I'm very excited to be here. First, it's a very unprecedented time. For the first time, we're hitting by 3 shocks at once, right? First, we have geopolitics jolting the supply of commodities. Today, we're sitting in Asia facing immense supply shocks coming from with Brent at 116 and with the escalation of the war, the duration of it will last much longer. And while we kind of experienced a bit of the reprieve of China demand shock, this filtering through of higher Brent, higher coal, higher natural gas, and not only that, agriculture prices and metals inevitably have created winners and losers across emerging markets. And with the obvious winner, so those net exporters, and the losers that are net importers, particularly countries that are closer to the periphery of the conflict. This shock, of course, you can see with these terms of trade and the trade structure have affected everyone quite significantly. And within Asia, we have the biggest loser, that is India. And Benito and Lisu are much more fortunate that they have much more winners than we do, particularly with the uncertainty of the duration of this shock. The second shock, of course, is the China shock, which we have breathed a bit of reprieve. But the China demand shock, if it's easing, and we have to see how the extent of which it's easing, but at the very least, the delta is improving, has added to this because the demand normalization of China will only add to the inflationary pressures. And that inflationary pressures have been felt across the region very differently. And the second thing that has impacted the region, of course, is the Fed. The much more hawkish Fed have put pressures on the region. The question is, are we at the same economic cycle? Do we have the fundamentals to follow the Fed? And that question has led to different performance in currencies, adding to this inflationary pressure. And that inflationary pressure have different reaction functions because those such as Asia has refrained from doing so are going to have less appetite to refrain from doing so as food inflation, which is basically derives 70% from fuels, and that continues to be elevated. So when we look across the region, we have Benito's region starting hiking much more aggressively, starting in 2021, in 2022, and they're very lucky in that they're going to end soon. And what does that mean for growth for that region? Benito will go into it. And Lisu is also very fortunate in that she has these Eastern European countries that face significant inflationary pressures, but they also have hiked quite significantly. And there's only a little bit left to go. Whereas in my region, we have refrained from doing so, but that pressure is going to be felt, and that appetite to absorb the depreciation of FX will be much less and less, which means we're going to have to hike much more aggressively from the other regions, even though the nominal rate itself will be much less. We still have more to go, and the pressure will continue. And as a result, we see widening divergence in asset classes, particularly FX, where the earlier hikers like Benito financials are having a much more reprieve and have enjoy better asset performance so far. With that, I'm going to turn over to our chief LATAM economist to speak about a lot of the winners in this global environment where there are very few winners in asset price, but Benito is very fortunate to be covering this.
Thank you, Trin. So I'll be talking a little bit about LATAM, and let me see if I can manage how to do the presentation. Okay, here we go. How do I go back? Perfect. Thank you, Trin. So let me, before I go into the slides, let me just kind of say a few words about what's been happening in LATAM. So really, there's two stories that kind of dovetail in LATAM. One is obviously the commodity price increase, which is net very beneficial. And I go in the report, in the EM Monitor report, I go into the details of how beneficial it has been to every single country, simply because LATAM it's a net exporter of pretty much all the commodities, soft commodities, metals, and oil as well. So net is you know, it benefits from this shock. But the other kind of interesting story is the central bank tightening, which Trin was referring to, and LATAM was the first one to start hiking. And the story is interesting because in 2020, inflation and growth collapsed, sort of in tandem with everybody. But you know, this allowed central banks in Latin America to lower policy rates to, in a lot of cases, to historic lows. So you know, the story really starts with the pandemic. So central banks lower policy rates to historic lows. Inflation is also in many countries at historic lows. So it's, you know, but then quickly things turn around. You know, there's kind of a V-shaped recovery, and in 2021, you know, between March and October, inflation in LATAM was running above the upper bound of countries, about the upper bound of the target. Sorry. And as soon as that happened, central banks started hiking. So Brazil started hiking earlier, around March of last year, and Peru started hiking a little bit later, October. But it follows a pattern. As soon as inflation went above the upper bound of the target, central banks started hiking, even though there was a negative output gap. So the economies were recovering strongly, but there still was a negative output gap, of course. And it was interesting because at the beginning, the hike was very gradual. In general, in LATAM, and I would say in a lot of countries, there's a tendency to cut, you know, very aggressively and to hike very gradually. Well, LATAM central banks started hiking gradually. And then as inflation started to really accelerate, you know, the pace of hikes accelerated as well. So by the time the commodity price shock hit the region, which in terms of growth had a positive impact and it helped the currencies, but in terms of inflation, it really pushed inflation to and these are the graphs that are going to show, to, you know, above sort of higher than 10 years, in some cases 20 years. I'm talking about annual inflation. You know, then central banks were hiking in some cases 150 basis points, like in the case of Brazil. Chile also above 100 basis points, Colombia 100 basis points. So central banks were hiking early and later on in the process, you know, fairly aggressively. So what does it all mean? Well, it means that you know, they're going to be the first ones to cut. So get ready to receive rates in LATAM. That will be the first kind of big takeaway from my chat. Let me just say something about inflation, because I think that's, and about what to expect about inflation. So here, what I did was very simple. I kind of tried to come up with a band that reflects, the two standard deviations with respect to the average in the last 10 years. And inflation right now is a red line, is running above that band, but it will come down almost in every country. You'll see towards the end of the year, it'll get into the band, and by next year, and that's the blue line, it will get closer to the target, but still above it. But the fact that inflation will start coming down, I think it will help. It will allow for central banks to start cutting. Can we go to the next slide, Trin? Thank you. So we did the inflations of Brazil and Mexico. It is kind of the same, more or less the same picture for Colombia, Chile, and Peru. Inflation really kind of above the band, this historic band now. It will remain so throughout the year, and kind of coming down towards the end of the year. And then next year, it should really get closer to the respective targets. I'm not putting Argentina, because Argentina, it's in a kind of in a different bucket. Very quickly, inflation in Argentina should be around 65%. They're trying to follow the IMF program, but for now, getting rid of the subsidies, it's going to translate into higher inflation in general. And so they don't target inflation. So it's kind of a different story, more tied to the IMF program. So inflation should start coming down next year, and that should allow central banks to cut. So that is kind of, so now can we go to the next slide? The other big thing that I want to say is that in almost in every case, real rates are above the average for the past 10 years. Now, if we can go to the previous one, real rates are really high. If we can go to the previous slide, Trin, thank you. Exactly, real rates are really high. They're not at the highest. The kind of, they're not at the highest. They're getting up there. The reason they're not at the highest in terms of a real sort of ex-ante rate, taking into account 12-month forward expectations, is because inflation is very high. But what's interesting is that as inflation will come down, most likely inflation expectations will come down, and that will keep kind of that could in some cases actually elevate the rate without central banks doing anything. That's why I kind of sort of Brazil should hike to 13.25, 13.50, most likely given the last print of inflation. Chile will go to 9.25. Colombia will go to 9%. Mexico will go to 9%, and Peru will go to 6.50. All of those terminal rate levels will likely be reached in the next months or so. The first ones to go to terminal rate will be Brazil and Chile, which of course were the first ones to start hiking and among the most aggressive hikers in terms of the tightening cycle. Let me just finish with an analysis that I did about the commodity shock. And what I did in the report is kind of very simple. It's kind of divide every country in terms of the type of commodity that they export. And the first takeaway is that all LATAM countries, the 6 major economies to be more precise, are net exporters except Mexico. Mexico is a net importer of commodities. Mexico is mostly an exporter of manufacturing goods to the US. And even though it exports oil, it imports more gasoline. So in terms of the gasoline, oil and gasoline, it ends up being a net importer. But the rest of LATAM is a pure net exporter. Argentina and Brazil have a much better combination in terms of oil and gas, cereal, and metals. Chile and Peru are mostly sort of metal producers. Between the two of them, I think they provide above I think 60% or something crazy of the whole the supply of copper in the world, or up there, you know, in that sort of a ballpark figure. And Colombia, it's a mostly an exporter of coal, oil, basically. If we can go to the next slide. And something that is very interesting is that the correlation between growth and commodity prices, we can go to the previous one, turns out to kind of pick up when commodity prices commodity price increases. So we can see those correlations going up, and that's why I think growth in the region has surprised on the upside, at least in the first quarter. So I'm kind of revising most of the GDP for my GDP growth forecast for the year, basically on the back of what's happening in the first quarter, and that has to do a lot with an increase in commodity prices. Last, if we can go to the last slide, and I'll finish and pass it to Li Zhu for EMEA. If we can go to, yeah, exactly. One thing that I want to say about Mexico is that even though it's a net importer, high oil prices really help Pemex. And to the extent that Pemex is doing better, sort of the macro risk, the main macro risk for the sovereign and for the economy is Pemex. So to the extent that higher oil prices help Pemex, that really helps the perception of risk in Mexico. And that's why the Mexican peso, I think it's doing so well. I don't have the view here of the currencies. We have a view in a quick view on the report on the EM monitor, and also we'll be publishing our global FX monitor in the next few days. But really, kind of all the LATAM currencies are doing very, very well, and I expect them to continue to do well in the remainder of the year, maybe with a slight depreciation to the extent that you know, maybe we see a little bit more pain in U.S. equity prices, and that there won't be additional increases in commodity prices from these levels. But in general, I continue to see price stability in terms of the currencies, a mild depreciation in the remainder of the year. And then next year, I think as commodity prices stabilize or start to come down and central banks start cutting rates, we should see kind of weaker currencies in LATAM next year. I'll end it there. I'll pass it to Li Zhu for a view on EMEA.
Thank you very much, Benito. And well, I'll take much of what you just said, notably concerning the importance of the condition of each country being net commodity importer or net commodity exporter, because this is one condition that definitely marks a massive difference between EMEA, emerging economies. So diverging paths, not only for growth, but only for monetary policy. So indeed, well, net commodity exporting versus net commodity importing countries marks a sharp divide between the countries that we follow. That on one side, we have Central European economies that were already suffering a lot from inflationary pressures and also the activity slowdown of key economic partner, the euro area. And on the other side, and Turkey as well as net commodity importer. And on the other side, the Gulf net oil economies, exporting economies, well, to know Saudi Arabia, the UAE, and Qatar, Kuwait. So at the beginning of the year, at the end of the year, I mean, the beginning of the year, we had a very positive outlook. Despite this massive difference, we had a quite positive outlook for growth for our two blocks of countries, and obviously these prospects, you know, after the start of the Russian-Ukraine war, I mean, it's an element that absolutely came to shake the whole outlook that we previously had for, notably for Central European countries. So what we have done so far is that, well, we have cut basically the result of all the global environment. Well, we'll go through that gradually. Is a GDP outlook cut for Central European economies. Well, to know, kind of, we're going to focus on Poland, Hungary, and the Czech Republic, who are three economies that are extremely exposed to the Russian conflict. I mean, not only because of trade links, but notably high energy dependence link from Russian oil and gas exports. So over the first quarter, just as Benita said, for Latin American, for some of his Latin American countries, we see a quite resilient activity for CE3 economies. We had GDPs that came out more robust and more positive than we initially expected, but those are numbers that do not reflect yet the likely impact of the Ukrainian war into the economy. So far, we've seen flash estimates that have been quite constructive. We've seen PMIs, manufacturing PMIs for Central European countries that remain well oriented. Actually, this morning we had the last numbers for May, and we see there is a slowdown in the manufacturing activity, meaning that the first effects of the war in the Central European economies is starting to bite, meaning that the promising outlook that we initially had at the beginning of the year, I mean, things are going to get a bit more difficult for those countries, and not only on the activity front, but notably on the inflation front, because, well, we had already countries that were suffering from inflationary pressures since very early in 2021, with central banks as well. I mean, we had LATAM, like the first wave of central bank hikers that were followed by Central Europe central banks, with Hungary being the first European bank that started hiking its rates in June 2021. But nevertheless, and despite a massive action of monetary stances, we have right now two-digit inflation in most Central European countries, that also meaning Bulgaria, Romania, Serbia. I mean, the whole Eastern European countries are really facing massive inflationary pressures. And we expect that this will remain the case throughout 2022, and we expect a mild slowdown in 2023, but a high inflationary environment that has been also supported by the recent, I mean, obviously the Ukraine war also has put massive pressure on the food prices front. We will have central banks that will continue. I think we have somewhat a 200 basis point rate hikes on the card on average for the Hungarian, the Polish, and the Czech central bank. But also, as you know, I go with some kind with some Latin American countries as well. We expect that the sluggish growth that will eventually derive from the current situation will push Central European central banks as well to start cutting rates, maybe later next year, sorry. So central banks to stick to hawkish stance, but not for very long. So we still have a few rate hikes to go, with foresee terminal rates for Poland, Hungary, and Czechia at 7.50, 8.15, and around 7%. And thereafter, we will see central banks start cutting. Somewhere in the middle, we have Turkey, which has, despite structural weaknesses, its high exposition to the global conjuncture and the massive depreciation of its currency, has a quite robust activity and GDP. We just got the number of the Turkish Q1 GDP that came out at 7.3% year on year. But weaknesses and risks are really clouding the whole global picture for the economy in Turkey, for which we expect GDP to be below 3% this year. And a major issue for Turkey is obviously inflation. I mean, inflation reached 70% in April. And we have, I mean, Turkey, which is a high manufacturing and manufacturing intense economy, but also a net commodity importer, is facing, I mean, the all pass-through effect from inflation at the production prices level, food, energy, transportation. I mean, at all the levels, I mean, inflation has been hitting very hard, pushing the Turkish central bank, you know, against the wall. I mean, the Central Bank of the Republic of Turkey was meant to be cutting rates over the past month, and the Monetary Policy Committee has been able to take action because of this massive inflation that is present. And somewhat this situation that is going globally in a bad direction may imply for Turkey a political shift. I mean, we have general elections coming up next year, and maybe social discontent or, you know, social tensions may cost Erdogan its will to be re-elected on the next year elections. And then moving on the opposite, I mean, to the global, to the Middle East and to the Gulf Cooperation Council oil exporting countries. As Trin said, those are like really the big winners. I mean, at the same time that we have been cutting and revising Central European countries' growth down and inflation up, it's been the opposite for oil exporting countries that now benefit for a very sound and robust economic outlook for 2022, basically supported on high oil and energy prices. And this despite a progression in inflation, surging inflation. Those are countries that import pretty much all their food. We all know that you know, the food staples are, you know, are being may suffer some shortages in the coming months. But despite surging inflation, we have revised upward our outlook for Saudi Arabia and for the United Arab Emirates and Qatar this year. So basically, big winners, and obviously Russia is I mean, all the situation that's been going on. I mean, the yesterday's or Monday's night decision of the European Union ban on all Russian oil imports would likely benefit pretty much the presence and will benefit very much Saudi Arabia and OPEC countries who will eventually have to cover up for some part of the market share loss of oil exports that will be resulting from these Russian bans. And those are countries that, because of their peg, their currency pegs to the dollar, have mildly started to hike rates following the Fed. So we still see a bit of room to go for Saudi Arabia and United Arab Emirates central banks to start following the Fed gradually. Just the last word on Russia, because it's one of the countries that we cover. So, well, Russia prospects are not very promising. Obviously, sanctions growing with each day it passes. So we did cut our growth forecast a few weeks ago from a positive 2.7 before the war. And we anticipate a recession that should stand between -10 to -15 GDP figure in 2022, and also a negative figure in 2023, with tons of uncertainty remaining around the global context for Russia. So that's all for me. I leave the floor again for Trin to give us her outlook for Asian countries.
Hi, good morning, good evening, good afternoon. Emerging Asia as a whole, I cannot say with such a great enthusiasm that we're winners, even though our very few winners, which is Australia, mostly metals, iron ore, Indonesia, a bit of a mixed bag, coal, palm oil, and Malaysia. So they're not big winners like LATAM or Middle East. They're just mild winners. And all of emerging Asia, all of Asia suffer from, even net exporters, from the fact that they're going to face higher inflationary pressures, particularly with food inflation going to be quite significant. And Asia face the three shocks, right? We know that we face the China shock, the Fed shock, And before we talk about how these different countries absorb the shocks, we have to also cover how they exit COVID. As you know, China hasn't exited COVID. It still has zero COVID policy. And we're celebrating the fact that today is its beginning of the opening of Shanghai lockdown. And the question is it going to actually fully exit? And I live in Hong Kong, where we're actually backpedaling some of this. And what that means is that our normalization process, our divergent path, has a lot to do with the fact that we, on the one hand, we have India, South Korea, ASEAN normalizing, having mobility. On the other hand, you have China having its own suppression. So it's really the one doing the suppression to its own service sector, manufacturing, and also through regulatory suppression. And as a result of that, we have this divergence of performance. And so as we celebrate this moving out for EM Asia ex-China, we face with the 24 February invasion. That shock, which initially we thought would be short, is that the big question mark is, as we escalate, the duration of the shock, and as the supply of energy is relatively inelastic, and we're still very much dependent on fossil fuel, where about 84% of global consumption is still that. And even with a weakening demand scenario towards the end of the year for the global outlook, and as a deceleration of demand, we still have strong demand. What that means is that this duration of the supply shock is going to continue to create winners and losers within emerging Asia, winners and losers within emerging markets, and that divergence that we see is going to be particularly acute. So first, let's look at the commodity shock. The one that I think will be the longest of all the shocks that I mentioned is the fact that it's going to create, we did many things, econometrics, you can look at the structure of the net fuels. You can see that across the board is negative. It's a drag on the current account. So only a few have a net positive. So as a region, we lose because we're the huge importers. We determine the price of commodities because for China, it's really metals, but really not just China. India is a huge commodity importer. So is South Korea. So is Thailand, and so on and so forth. So this is a drag on the current account for us. The good news for us is that we're a huge manufacturer. So South Korea has amazing exports because it has chips. So the chips offset for the deterioration of the imports. Even so, South Korea has a trade balance deficit. The one country, although its net export of fuels is not as large as a share of GDP as, say, Thailand or South Korea, it actually doesn't have other offsetting factors. And that country is India. That country is India, and that Indian inflation is accelerating very fast. And the Indian acceleration is going to be felt in the second round effect when fuels goes into food. And actually food is shocked anyway, but you're going to have the second round effect because you need fuels for making food. And India is also facing a very unfavorable seasonality right now, which is the summer. It's very hot. You need more coal to really cool things down. You need everything. So as a result, our analysis shows that India is most affected and the biggest winner is Indonesia. But even Indonesia as a winner, we're only talking about exporters winning. Households are going to be affected. And the choices that face will be different, right? For all these countries, I have three choices. A, if you're a net exporter, very good. You can choose to then slow the export, ban it, and then protect your domestic market. You lose exports, of course, and maybe employment in the exports, but you help push down inflation, right? Countries like Malaysia can do this, Indonesia can do this, and say, et cetera, et cetera. But countries that are net importers don't have such a choice. What can they do? They can reduce the duties, which is India had done. What that means is that then you have less revenue and your deficit widens. So you actually don't subsidize, but you still have a widening deficit anyway. Or you can subsidize like Malaysia or even Thailand. But as oil prices go higher, your appetite to subsidize reduce because the hit on the revenue will start increasing, right? So a good example is that we think Thailand has refrained from hiking, but we'll have to hike because the subsidies are going to increase. And as the subsidies increase, the state company will have to increase the price to reduce the burden on the state. So these are all very difficult choices. And finally, It's really the hiking of interest rates, which as Asians, we don't like to do because we're faced by another shock that I'm going to talk about, which is the China shock. Actually, I have the Fed first, but let's talk for the Fed first. The reason why Asian central banks have refrained from hiking is really we have a very weak China, as I mentioned. A very weak China is very important for the world and important for the region. And as a result of that, and on top of that, we have a very terrible 2021, particularly for ASEAN, because we still follow China and zero COVID. We only turned the corner towards the end of the year. So we really need this recovery, particularly Thailand. We need the tourists. We need to have cheap interest rate to really shelter this nascent recovery. So we have refrained from hiking. And what happens when you do this? The monetary policy divergence, particularly as inflationary pressures start to pick up, push capital flows out, particularly on the bond side. And when that happens, it puts depreciation pressure on the currencies. And what happens when that happens? What that happens is that you have to ask yourself, can you stomach a depreciation of the currency? Do you care more about the FX, or shall I say inflation, because the FX eventually passes through imports, or do you care more about your growth? And for many of these countries, they prioritize growth first, but as inflation pick up, as you saw in the earlier charts, inflation becomes a bigger concern. And as inflation becomes a bigger concern, you then forego growth to really focus on inflation. And particularly a country that I want to emphasize is India, which is a title of the Asia section, is that it has to pull all the stops. Food inflation is very important, and food as a share of CPI basket is 39%. If you add fuels and you add liquids, then it's 55%. And at that level, and that's an average, right? At that level, you really need to do everything you can. And the third shock, of course, is the China shock. The China shock is very important, even in Europe, right? Because China matters. When they're locked down, they're not buying goods. When people are locked down, it affects not just demand, but supply side, adding to this inflation and pressure. So we all want China to exit out of zero COVID, and the rallying of the market since several days ago when this news happened is really about this hopeism that this shock would disappear. And we have done many studies on what is the impact of it. Of course, China is important for the commodity markets. You know, it's estimated when during this lockdown, you reduce about 2 million barrels, right? So that pressure, downward pressure, offsets some of the supply shock. But even in the peak of China's zero COVID, oil was still high, commodity prices is still high. What that tells you is that the supply shock, no matter how important China is for the demand, global demand, particularly in the commodity market, where it's a price maker, is still not enough. And exactly as that happened, when China has news of removing some lockdown, commodity prices went crazy, right? And on top of that, we have escalation of tensions. And so we think that given the unsustainable path of lockdown, they have to exit. So at the very least, we know the Fed, and I believe in Joe's call, that as the hikes filter through, it pushes down growth, the Fed will pause. China, as the contraction of contraction of imports, contraction of manufacturing for the second stimulus, they will have to pause. So that means that the positive end of it, which is India benefiting in some of this, is actually it's going to face this persistent supply shocks, right? As China normalizes, it will demand more of the very thing we're short of, which is commodity, particularly fuel. So that supply shock, and particularly if the duration of conflict will continue, right? This is really what it's about. All these shocks, it's really the question of duration of the shock. If we think about the second half of the year, because we're sitting at towards the end of the first half, is really the duration of the shock. And if the duration of the China shock and the Fed shock fades a bit, we still have the supply shock. And so as a result of this, we think that emerging Asia will have to hike. The biggest hikers would be India and even Indonesia, the biggest winner of this. And I'm sorry to say, but we're not really roaring here. We're just barely winning, right? Even Indonesia, with all this term of trade positive, is still having a balance of payment negative because of these capital flows, outflows, right? So we think that Asia is still resilient because we're normalizing activity, ex-China. And that normalization of activities this substitution impact, this importance of Asia as a manufacturing center still gives us resilience. But we are facing persistent shocks that are very negative for us. And unless there is compromise between Ukraine and Russia and the West and Russia and the easing of geopolitics, the persistence of the shocks, unfortunately, will mean that Benito will be laughing a bit more than me, and I will have to do more risk analysis, and I have to deal with the countries that will have to hike more, and the negative impact that will have in the region. But in other words, but still, we're not talking about a sovereign crisis, because as a region, we have very high external balances. If you look at the defaults, there's nowhere in emerging Asia. It's really Sri Lanka that's really falling off the cliff. We're here. And as I mentioned, we're going to do everything we can. Don't forget the first chart I showed you, inflation. Inflation in the region is rather good because the cost of inflation going out of control means that we're going to do everything we can, including rate hikes that we don't want to do, including subsidies, including removal of taxes on these things. So as a result, the ones that would do most of it will be India. So in the short term, negative India, but longer term, let me end with a positive tone because we like to end with dessert.
You have 2 minutes, Train.
Yeah, so the longer term is that the diversification will continue to be key. And what the PMIs today, which show Vietnam accelerating, ASEAN resilient, India resilient, and South Korea exports accelerating up double digits, shows that Apple is going to follow Samsung. What does Samsung do? It has a diversified supply chain. And not only did it move its supply chain to Vietnam to diversify too much concentration risk, recently it moved from Vietnam to India and even onshore. So that means that increasing in the world, we will have to think about this, not just manufacturing, China concentration risk, but even too much risk on Benito's country in terms of minerals and metals, right? And increasingly, as we do the energy transition and everything becoming more expensive, and we depend on very few, and that's what we learn. Energy security, not just now, in the future, what that terms will take, and the supply shocks and the duration of it will lead to more investment, more diversification, and more demand for places that such as emerging markets. So thank you very much. I'm going to take questions now.
Good, thank you very much, Train. And actually, I forgot to tell you that we're opening a Q&A after the presentation. So if you have any of them, please feel free to go through the messenger. We already have one question. I think that Benito, maybe you kind of give a hint for a reply to it. Someone asked, why would inflation come down? I mean, is there any data to support your claims?
Yeah, I think it's an excellent question. I addressed it in the chat, but I think it's very good. You know, it's very good because inflation it has been a historic problem in LATAM. Once it starts, you know, it stays high for a long time. There is an indexation problem, or has been in the past. You know, you have wages kind of resetting. So in that sense, I think it's a very good question. The reason why I think inflation is going to come down is because growth will likely decelerate in the world. There is some probability of recession next year. The second aspect is because it's very difficult to think that in an environment of global growth deceleration, commodity prices will increase at the same pace, and it's the pace that matters, not the level, at the same pace in 2023 as in 2022. And the second thing is it's kind of a simple reason, which is, you know, we're talking about all these inflation targeting regimes are based on annual inflation rates, not on month over month. So you have a base effect. If inflation, if the level was very high in 2022, you know, it's very difficult to see, you know, even higher inflation the following year, given, you know, what I'm trying to say is that there's a base effect kind of built in the process. Now, having said that, I think that inflation will not go to the target in any country in 2023. It will probably be between the target and the upper bound, maybe slightly above the upper bound of the targets of the central bank. And we will only see inflation hitting targets maybe in 2025. So yeah, I mean, it's going to take a long time for inflation to converge in most of the countries in Latam.
So it's more slowdown than a real, return
Right.
to the normal levels.
Right.
Very good. So we don't have any other questions.
I think people are shy before just to give them a little bit more time. Let me just say something that Trin said that is very, very sort of exciting and very interesting, which is this move of supply chains around the world. And she talked about sort of moving within Asia, but there is the possibility that some supply chains are moved to Mexico, out of Asia into Mexico, particularly for U.S. companies, because of the proximity, because of already Mexico being a manufacturing sort of exporter. So there is a possibility, and there is evidence that in the north of Mexico, real estate, commercial real estate is going up like crazy. So there is kind of an active look for places to set up kind of plants to move companies out of Asia into Mexico. Now, the big challenge for Mexico is twofold. One is violence. A lot of the highways in Mexico, there is sort of a narcos or other sort of bad actors, and that's going to play a big factor in terms of sort of companies deciding going to Mexico. And the second thing is that this government has really been very aggressive in terms of not allowing sort of permits to import gasoline, to import gas, and for the production of electricity of the private sector. It kind of wants to return to the monopoly of the state in terms of electricity and gasoline and oil. And that's very bad because manufacturing is super intensive in in gas and also in electricity. So that might also play against Mexico. But I believe that some diversification will go to Mexico in the coming years. So it's a fascinating thing how, as globalization decreases, it will look for other places, to where it's a little bit more friendly, and one of those places could be Mexico.
Okay, we have another question for you, Trin. Someone asks, are we expecting future political crises in countries as food crises deepen in some Asian, but also elsewhere?
Absolutely, you're already seeing it, right? You see that in Sri Lanka, for example. You see that in Tunisia. I think this is a huge problem for Africa. It's a huge problem for in the Middle East country, in at least who have at least a very rich. So here, food crisis is across the world. The question is how rich you are in terms of you can throw money at the problem. And you have several ways to do it. You can subsidize it, right? You have to subsidize either fertilizer for the farmers so they continue to create the production. That's what India is doing. Every time oil goes up, there's a hit on the budget, right? India has to subsidize, and they have more than 1 billion people to feed, right? 1.3, 1.4, depends on which statistic you like. That's quite a number of people. And so for India, it's very sensitive. And India is very different than other countries, is that it doesn't really have a middle class. It has a lot of poor people and has a lot of rich people, of very few rich people. So these very poor people are going to be very sensitive to it, right? So this is why you saw food protectionism in India. The worry about India is that will it turn to rice because it exports it has 33% global market share of exports. And if it bans rice exports, it's going to be a huge problem for Africa, which is already facing higher wheat prices, particularly places like Egypt, where they use a lot of wheat, right? So as people substitute away from wheat into rice, and if India tries protectionism, then Vietnam will follow. And then Vietnam is very important. And if price goes up, then there's Thailand. So actually the issue is that will Asia be a problem for the rest of the world? Because Asians are very sensitive to this, and we would do everything that we can to avoid from that happening. And you already saw a lot of that actions. Palm oil export ban in Indonesia only to recently reverse, where they realized actually 17 million people work in palm oil, right? And in Malaysia banned exporting of chickens, and now Singaporeans cannot eat Hainan chicken without feeling some pain and inflation. And Singapore is not a worry, so we worry more the poorer countries in Asia with high CPIs basket, particularly countries. So really India, the Philippines, Thailand, and the more you worry about these countries, the more you will see they will do much more. And this is my title. India will do everything it can. It will throw everything at it, and that will have a cost. But the good news is, at the very least, in Asia, except for a few countries like the Philippines, really, we're net exporters of food. What does that mean? That means that we have choices, and these choices are not going to be good for the rest of the world. And the fact is that to make food is very expensive these days. And if the crisis continues, the pressure cooker will continue. And what that means is, will the conflict in Africa will create a lot of issues in Africa, particularly Northern Africa, and that will then can infect developed markets.
Yes, actually, I would like to add a line to what you're saying, because obviously I just spoke about oil exporting economies of the Middle East who are rich countries and who, despite surging inflation, they can still manage to have a political, and a social stable environment. But as you just said, there are some countries, Northern Africa, you have Morocco, Algeria, Tunisia, you have Egypt, who are net importers of wheat and sugar. And where, I mean, if we go back in time, it was actually inflation and a massive rise in food prices what triggered the Arab Springs, I mean, a few years ago. So the risks for other Middle East and African countries that are not oil producing economies to suffer from this massive food supply disruption or net flows, because, as you say, in Asia, as you produce, in many of these countries, they don't produce anything. So basically, this supply shock that that is about to materialize maybe in coming months, and we don't know for how much longer, will definitely represent a risk, a social risk for many emerging countries. There's another question. Maybe we're going to close on this one. It's about China, but just before reading it, I invite you all to read our Emerging Markets Monitor report. Please go through it, and above all, know that Benito, Trin, and myself are here for you in case you have any questions or any doubts. I mean, very nice and platform for emerging economies coverage. So feel free to reach out whenever you want. So this last question, Trin, for you: how much impact will there be on the Chinese GDP and the global GDP because of the reopening of the Chinese economy, if you eventually can have a figure or a number concerning concerning China? And is the removal of the tariff on Chinese imports into the US a good move?
Oh, those are great
Do you have a
questions.
word? Do you have a word?
So I would say, like, on a sequential basis, depends on how you look at it, right? So I think, if you look at China, the normalization of it will certainly help. And on a sequential basis, from the second quarter to the third quarter, you already saw today the data. It shows a deceleration of the contraction. So what that means is that in June, we're going to see an improvement. But if you look at the performance, I think if you zoom out a bit, this year will be a weak year for China in terms of growth, just because of the impact. And I think if you look at a lot of the numbers, which means that they will require a lot of support. A lot of the support so far has been car subsidies, support, but we will need much more support to really offset the contraction of the private sector. So you see that acceleration. In other words, there will be a juxtaposition in the first half. In the second half, there will be an improvement. But as a year, it will be a weak year, and depends on which data you look and which sector. So as an aggregate, it's going to be growing at a low single digit, somewhere between 3.5 to 4%. So in the forecast of many economists which have already downgraded, they've already factored in the fact that China's second quarter is likely lost. So sequentially, and that's what the stock market is really pricing in, right? You're looking at the future since May, it has been proved. For the second question, which is the removal of the tariffs, right? Is the removal of the tariffs an indication of the end of the U.S.-China trade war and the strategic competition coming to end? The answer is no, right? First of all, we don't really have that announcement that they're discussing it, right? So you have the disagreement between Janet Yellen and also the Tsai, the negotiator. So the removal of it will ease some inflationary pressure, but it doesn't take away all the trends we've seen, which is diversification of supply chain because of this risk. What happens on 24th of February with Russia and Ukraine has implications in Asia, because we start to think that the fact that realignment of Putin and Xi means, particularly from Europe, the relationship has deteriorated quite sharply, right? And not just the US. The US has always been the case with Biden. And increasingly, what that means is that for many people, they're going to ask the question of a very, very difficult scenario that hasn't been pondered before. And what that means is that you will continue to hedge this risk, even if China is a very important market, even if China is the second largest economy and likely to be an important one, that geopolitical risk will require diversification to planes, and particularly if you want to serve the US market, which continues to be quite important, and increasingly the European market. So I would, it's very difficult for me to say, is it a good or bad? Because tariffs themselves don't really change strategic direction, right? So if you talk about the US, does the tariff improve productivity of the US? Unlikely so. Did the tariffs have a push in moving the supply chain? Yes, but really supply chains are moving for many more reasons. For the fact that regulations, for example, for the fact that China is aging, for the fact that even if we expect the second half to improve in China, longer term growth, for many reasons described, will mean that growth in China will be much slower. So that means sectors like asset management or helping the silvering economy will grow, but other sectors will not grow, right? And so as a result, this is very easy money to be made in China is likely over. It's very difficult to say it's a good or bad decision, and it remains to be seen that it will be made. But it certainly reflects the fact that inflation is a huge concern for the US, to the point that that is being discussed, and inflation is a huge concern for everybody across the globe, even the winners of commodity prices. What differs is the choices that we have that we can make, and the wallets we have to throw at the problem. But all these decisions have consequences. And finally, I think I will end with this point, that what matters is duration. And what we see is very tightness in supply. Many people think that supply is relatively elastic. As long as price rise, you can have more in the future, etc., so on and so forth. And I think the environment here is very different, and we have to ponder this question with our energy analysts. But it's very clear that it's very, very tight. And all this tightness leads to the duration to last much longer than we think. And the trends that we discussed today with Benito, Li Su, is likely to persist a bit longer, even if we remove the other two shocks that we discussed.
Thank you very much, Trinh. There are still a few questions that have been coming over. We're running out of time. It's been an hour now that we've been together. Maybe last one question, Benito, 1 minute. Can the future slowdown of the pace of inflation lead to a deflationary pressure at some stage? And we'll finish with that.
Yeah, I mean, look, so inflation will sort of come down. I think because of the reasons that I said before. kind of difficult to say that it will go below target until maybe in a couple of years. I think so. So as I was explaining before, at least in Latam, and I think in the rest of EM is kind of the same. So once you have an inflationary sort of process starting, there's other things that kind of start with that process, like an indexation process, wage setting, and all of that kind of make the process a little bit longer. So it's not only about sort of commodity prices go down and everything goes back to normal. This idea of that that the Fed speak sort of the board thought, and all the central banks in the world, to be honest with you, we're saying this is going to be a sort of a very temporary process. We're finding out that it's going to take longer because it's been a series of shocks that happen. No, it's very difficult to predict what's going to happen in the future. So I think it'll take time for inflation to go below the target, maybe 2026 or something like that.
Okay. Well, I think the moment has come to say goodbye. Thank you very much to all of you for joining us. Well, thank you also. It's been a pleasure to share the floor with Benito, with Trin. We don't do it very frequently. I hope we'll be doing this on a more regular basis. So please feel free to reach out for any questions. Our contacts are on the slideshow. We'll be circulating it between the participants. And again, thanks very much for being with us today.
And one quick answer to the last question. The answer is yes. Thank you very much. Sorry, I didn't have time to explain. Please message me. Bye-bye. Thank you.
Thank you. Adios.
Bye.
Thank you. Bye. Bye.